In this course, we'll discuss the use of financial statements, financial analysis, and budgeting as management controls. Budgetary control, one of the most commonly used methods of managerial control, is the process of setting targets for an organization's expenditures, monitoring results, and comparing them to the budget, and making changes as needed. As a control device, budgets are reports that list planned and actual expenditures for cash, assets, raw materials, salaries, and other resources. In addition, budget reports usually list the variance between the budgeted and actual amounts for each item. The fundamental unit of analysis for budget control systems is called the responsibility center. A responsibility center is defined as any organizational department or unit under the supervision of a single person who is responsible for its activity. Budgets that managers typically use include expense budgets, revenue budgets, cash budgets, and capital budgets. Let's take a look at each. An expense budget includes anticipated and actual expenses for each responsibility center and for the total organization. An expense budget may show all types of expenses, or it might show a particular category, such as materials or research and development expenses. When actual expenses exceed budgeted amounts, the difference signals the need for managers to identify possible problems and take corrective action if needed. The difference may arise from inefficiency, or expenses may be higher because the organization's sales are growing faster than anticipated. Conversely, expenses below budget may signal exceptional efficiency or possibly the failure to meet some other standards, such as desired levels of sales or quality of service. Either way, expense budgets help identify the need for further investigation but do not substitute for it. A revenue budget lists forecasted and actual revenues of the organization. In general, revenues below the budgeted amount signal a need to investigate the problem to see whether the organization can improve revenues. Revenues above budget would require determining whether the organization could obtain the necessary resources to meet the higher than expected demands for its product or services. Managers then formulate action plans to correct the budget variance. The cash budget estimates receipts and expenditures of money on a daily or weekly basis to ensure that the organization has sufficient cash on hand to meet obligations. The cash budget shows the level of funds flowing through the organization and the nature of cash disbursements. If the cash budget shows the firm has more cash than necessary to meet short-term needs, the organization can arrange to invest the excess to earn additional income. In contrast, if the cash budget shows a payroll expenditure of $40,000 coming at the end of the week, but only $30,000 in the bank, the organization must borrow cash to meet the payroll. The capital budget lists planned investments in major assets, such as buildings, heavy machinery, or complex information technology systems, often involving expenditures over more than 1 year. Capital expenditures not only have a large impact on future expenses, but they also are investments designed to enhance profits. Therefore, a capital budget is necessary to plan the impact of these expenditures on cash flow and profitability. Controlling involves not only monitoring the amount of capital expenditures, but it also is about evaluating whether the assumptions made about the return on the investments are holding true. Managers can evaluate whether controlling investments in a particular project is advisable, as well as whether their procedures for making capital expenditure decisions are adequate. There are several types or approaches to budgeting that managers and organizations use. Zero-based budgeting is an approach to planning and decision-making that requires a complete justification for every line item in a budget instead of carrying forward a prior budget and applying a percentage change. A zero-based budget begins with a starting point of $0, and every dollar added to the budget is reflected by an actual documented need. By forcing managers to evaluate and justify the costs and benefits of each dollar, zero-based budgeting can help organizations shave excessive and unnecessary costs from their yearly expenditures. Budgeting is an important part of organization planning and control. Many traditional organizations use top-down budgeting, which means that budgeted amounts from the coming year are literally imposed on middle and lower managers. In top-down budgeting, managers set departmental budget targets in accordance with overall organizational revenues and expenditures specified by top executives. Although the top-down budget process provides some advantages, the movement towards employee involvement, empowerment, participation, and learning means that organizations are adopting bottom-up budgeting, a process in which lower-level managers anticipate department resource needs and pass them up to top management for approval. Organizations of all kinds are increasingly involving line managers in the budgeting process using this form of bottom-up budgeting. Budgetary control, one of the most commonly used forms of managerial control, is again the process of setting targets for organization expenditures, monitoring the results, and comparing them to the budget, and making changes as needed.